In this final chapter, we conclude with a brief discussion of why conduits in general, and SIVs in particular, have fared so badly during the credit crisis. The first signs of trouble arose around the third quarter of 2007, when a number of SIVs and MSVs were found to have significant exposures to U.S. subprime mortgages, either via purchases of mortgage-backed securities or through ownership of collateralized debt obligations, CDOs, in turn backed by mortgage-backed securities. These various instruments are discussed comprehensively in some of our other modules. For a few vehicles, the exposure to these distressed securities was so high that it quickly triggered liquidation events. In two instances in particular, which involved SIVs sponsored by German banks, the price erosion of the assets was so rapid that the capital notes were quickly wiped out completely, and the debt holders began suffering some loss of principal. News of these instances of loss spread quickly across the capital markets, causing, naturally, alarm among investors in conduits generally at all levels of the capital structure. For one thing, distinctions between MSVs that purchase only trade receivables, MSVs that purchase securities, and SIVs proved to be very poorly understood. Confusion prevailed as to which vehicles benefit from 100% bank liquidity support versus, in the case of the SIVs as we have seen, much lower percentages. Also as to which vehicles were required to liquidate their portfolios and under what triggering conditions. And very importantly, which ones own no U.S. subprime, or a little bit of U.S. subprime, or a great deal of it, and so on. It did not help matters much that the conduit sponsors and asset managers had sought to preserve as much confidentiality as possible regarding their portfolio allocations, on the basis that this was proprietary information best kept away from competitors. Panic reached epidemic proportions, and many investors that had the option of exiting the conduit, particularly the holders of CP and the shorter dated MTNs, voted with their feet. The market also began taking note of the significant refinancing requirements of the SIVs collectively, as summarized in this diagram from Fitch, which reveals some $20 billion on average of monthly debt maturities for the 12-month period beginning December 2007. It was not long before people understood that even for the healthiest SIVs, note holders were likely to opt out of refinancing the vehicle, in turn forcing the SIV to initiate asset sales in dramatic volumes collectively. The rapid disappearance of investors willing to roll over their CP and MTN soon triggered an obligation to begin asset liquidations. The SIVs, however, would be liquidating assets in depressed market conditions, making a bad situation even worse. And since many SIVs held very similar assets to one another, the stress felt by those particular assets would become even more pronounced. Capital note holders, in addition, recognized that an immediate liquidation would most probably destroy their investment completely, and therefore began entertaining proposals, which we will describe shortly, to diffuse the need for asset liquidations. And in the meantime, SIV sponsors, at least those that were commercial banks, became concerned for their reputations if they allowed CP and MTN holders to incur losses on what, in better days, they had marketed aggressively as paper with the very lowest risk of default. A variety of suggestions were contemplated to ease the pressure experienced by SIVs and reduce the need for simultaneous fire sales at the worst possible time. The two that were adopted the most frequently involved, in one case, the assumption by the sponsor of some sort of obligation to provide liquidity support to the SIV, or, in the second instance, to have the capital note holders, in essence, take out the more senior creditors entirely, the more senior debt, and become effectively the sole owners of the assets in the portfolio. This module will conclude with an explanation of these two approaches. Many SIVs, especially those sponsored by the larger money center banks such as Citigroup and HSBC, were deemed by their sponsors to be suffering more from the market illiquidity that was plaguing some of their assets, such as certain CDOs and certain MBS, rather than being fundamentally insolvent. Concerned in particular about their reputation in the marketplace, these sponsors decided to guarantee the SIVs access to funding sources, since they were comfortable with the asset's ultimate ability to recover towards par value once the crisis had passed. In some cases, the sponsors simply provided a term loan to the SPV in an amount sufficient to pay off the commercial paper and the medium-term notes entirely, and thereby became the sole providers of senior funding, lying above the capital note holders. In other cases, the sponsors gave a guarantee to the senior note holders, which encouraged them to continue rolling over their positions, safe with the knowledge that if they should change their mind at any time, the sponsor stood ready to replace them in the capital structure. In return for this guarantee, it would no longer be necessary to engage in forced sales of the assets to assure repayment of the CP and MTNs. In due course, the theory went, asset values would recover and the SIV would revert to a more normal operating mode. In other cases, particularly where the assets had in fact suffered significant mark-to-market erosion already as a result of real credit deterioration, the holders of the capital notes were asked to take out 100% of the senior debt via what came to be known as a vertical slice. As an example, a capital note holder that held 20% of the capital notes in our earlier numerical example would have to provide funds sufficient to repay 20% of the total CP and MTN. In return, the SIV would distribute to this capital note holder in kind, i.e. in paper, 20% of its total assets, and the note holder could now elect to hold these assets on its books until they recover, hopefully, without worrying about the consequences of fire sales at the very bottom of the market. To be sure, the vertical slice option made sense only for those investors who were cash rich and to some extent capital rich, since this option entails, in our example, the conversion of an investment of a mere $10 million, 20% of the capital notes, into one of $200 million, 20% of all assets in aggregate in the SIV, at precisely the time when liquidity and capital were becoming increasingly scarce for most banks in many jurisdictions. In conclusion, we should not be surprised, in hindsight, to find the SIV experiment end so badly. As with any structure with triggers based on market prices, there can be no guarantee that the market will continue to price assets at all times at anything approaching rational prices, especially in a panic market scenario. Historical observations of spread and price volatility, from which the rating agency stress tests derived so much comfort, proved of little value in the eye of the storm, given in particular the lack of asset transparency, the insufficient market understanding of the SIV structure, and the dramatic decline in liquidity and increase in risk premia. A vehicle or conduit that has access to term funding, such as certain CDOs, or that benefits from 100% liquidity support, such as the classical MSVs, would not have to worry about mark-to-market values of their assets so much. But those designed to liquidate assets upon a predefined erosion in mark-to-market of the asset values really stood very little chance once this crisis began. We conclude this module.